Dave Ramsey always says that whole life insurance is a horrible place to keep your money because of the fact that when you die, the big bad life insurance company keeps your cash value and all you get is the death benefit. Is he right? Is he wrong? How do we address this? And what is the truth? And so I have no interest in giving my opinion on this. What I figured I'd do is kind of cut through the noise and show you an illustration of exactly what whole life insurance can be utilized as a savings alternative. Talk to you about how does the cash value grow inside of the policy, how does the death benefit work, and when you die, does the life insurance company keep all your money or does that money go to your heirs? Let's get into it now. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video because I got videos coming out like this all the time. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and this video we're going to be talking about what happens to the cash value in your life insurance policy if you happen to pass away. Dave Ramsey obviously hates the idea that the life insurance company keeps your cash value, and ultimately I'm going to cut through the noise and I'm going to make the whole situation make sense, because the bottom line is Dave is right. Some of the times Dave is right. The life insurance company does keep your cash value. That happens all the time. You got a death benefit, you got cash value, you have the premium that you're contributing to, and ultimately the way that you're designing your whole life policy is going to have an impact on whether or not Dave Ramsey and the reason he has this vehement hatred for whole life insurance is accurate or not. So let me just do this. I'm gonna go to the board really quickly, and what I want to do is I want to put myself up here. And before I get into this, and I have some stuff there I'm going to show you. But before I get into that, what I want to do is I want to talk about, like, why does Dave Ramsey hate whole life insurance? So what he would do is he would say this, is you got a whole life policy, and he would say you have a, let's just say you had a $10,000 premium. So year one, he would say you have a $10,000 a year premium, and it would get you 0 net cash value. I'm going to call it NCV, and that would get you maybe a $500,000 death benefit. Right? We'll call it death benefit, DB, right? So net cash value. So this is what Dave Ramsey typically sees. And when it's a highly structured, all-based traditional whole life policy, Dave's right, because what happens is, let's say we get to year 5 and you've paid a total of $50,000 in. Let's just assume 5 times 10,000 is 50,000. Well, that's what it is. Let's assume you made the premium payments the way that it was scheduled. And what would happen is you would go down here and you might have like 15,000 of net cash value that you could borrow against, and the policy would be 500,000. So what Dave is saying is that because of the fact that you have this $500,000 and the net cash value is growing to 15, not only is this really bad because you put in 50 and you only have access to 15. And by the way, these numbers are maybe not on scale. I'm just doing the simple round numbers to teach a concept. And this is why Dave Ramsey hates it, right? So now you go year 10, you've put in 100,000-ish, and I'm going off the fly based on what I see. These policies, I've looked at about 1 billion of these things, so I can kind of look at that. And you might have like 60,000 in a traditional structured policy, but you're still going to have the 500,000 of death benefit. So in this situation, this is where I got to say, okay, Dave, you're right. You know, this looks bad, right? Like 60,000 of cash value, 500,000, and by the way, when you die, you only get this. Your heirs, I should say, only get this $500,000. They do not get the $60,000. Now, is that good or bad? I wouldn't say it's like bad, because the pricing of this is actuarially kind of baked in, and so it is what it is. Like they've taken the insurance schedule, they've put it out there. They've allocated it and annualized it. They figured out what the what the insurance costs are going to be, and then they bake in your dividends, and that ultimately is how it goes. By the time you hit year 15, you should have about the same amount of cash value typically as you put in premium. So you got 150,000. By the time that's said and done, you know, ballpark, you're going to have 150,000-ish. But you're still going to have this $500,000. And so this is where Dave Ramsey loves to hate life insurance. And you know what? If life insurance was only sold as this way, if whole life insurance only worked like this, and I would agree with him that this wouldn't be the best place. It would be really expensive, permanent death benefit, and there would be few situations or circumstances where I would agree that this is a good use case. But now what I want to do is I want to show you real world example. And what I'm going to do is I'm going to actually, let's do this. I'm going to go to this one first. Okay. And so now what I'm going to do is I'm going to show you this one, and let's take that same 10,000 premium, right? And let's go to the net cash value year one is $6,776, right? So I'm going to erase that for a sec to open room here. So $6,776. Now you can see here you got an $180,000 death benefit. Now here's where it differs from what Dave is saying, because if we go down over here, year two, you're paying $10,000. You can see that the net cash value goes up to $15,000. But look at this: you had $180,000 of death benefit. You paid in $10,000 of premium, but your death benefit went up by $16K. Okay. Next year, you put in $10,000 of premium. The death benefit goes up. You know, you're up to $24,000 now. But the death benefit went up another $17K, right? So is the life insurance going to keep your cash value here? Yes, they are. This, if you were to die, your heirs in year four would only get the $213,000. They would not get the $24,000. But the bottom line is, because of the way we designed it and structured it, the life insurance is going up by more than the amount that we're contributing. So this is really important for a couple of reasons. A, it's a way to counter inflation and your need for more life insurance as inflation continues to grow, right? That's a really important component that most people don't think about with life insurance. If you buy a 20-year term policy and you buy $1 million policy, well, maybe that's what you need right now. But most of the people that I know, if they're not dealing with an agent that they are that they have a good working relationship with, or an agent that knows what they're doing, they buy a 20-year term policy, and then probably till you're 15 to 18, they don't ever look at it again. But the reality is, if inflation is at 3 to 5%, which historically speaking it is, even though target rate of inflation for the Federal Reserve is 2%, look at historically since 1971, rate of inflation is 3.9%. So if we look at that, well, at 3.9%, every 20 years, your need for money is going to double. So that if $1 million was your number then, assuming that you didn't even increase your earning capacity and increase what you needed to make, or what your standard of living was, your need for insurance is going to go up, if assuming that you still have that need. And my guess is, even if you don't need it, you're going to want it. But you could see here, by the time we get to year 10, we've put in $100K, right? This is the cumulative premium, $100,000. You can see that you got $104,000 in net cash value. This is the part I don't understand why Dave Ramsey doesn't get this. You put in 100, okay? You've got 104. So basically this beats bank account. It beats your bank account, your savings account, or checking account, right? So it beats your bank account. And you started off with $180,000 death benefit. While you only put in $100,000 more, you got $160K more life insurance, right? So think about that. This is the biggest no-brainer in the world. So does the life insurance, if you were to die at, age 45 here, year 10 in the policy, your family would only get the $349. The life insurance would keep this. But why is that the case, and why is that good? Because if the life insurance company were to segment it all, what you would really have is you'd have $180,000. And then with the $180,000, let's say you built up, and let's say they paid you both. They would pay you $180. I'm just gonna round this off. Plus 104, obviously is 184, or 284, sorry, obviously. $284,000. So they would do this, but here's the deal. If they were to do that and segment it off, this $104,000 is likely going to be taxable if they do that, just like a savings account would be, right? So that would be taxable. Not only, so now when we look at this, we go, what is 284? 349 minus 284 is 5, 14, 6. It's $65K, $65,000 of more life insurance, plus this $104,000 works on a tax favorable basis. It's going to basically flow. When we look at the efficiency of money, it's going to flow through, and you're going to basically get the 349. So it's just It's leverage. That's all this is. It's utilizing the tax code to your advantage, utilizing these policies that are designed for you to be for you to be a benefit of the system because you're a good steward of your money, because you're making good decisions, because the government knows that if you're doing a policy like this, it makes it so you are less of a burden on society and you are doing your job as a good citizen. I mean, that literally is why life insurance has the tax beneficial status in the tax code, is because they want to make sure people are incentivized to make good decisions and not become a ward of the state, basically, right? Like that's important. Now, let's go and use an extreme example, $110,000 dump in. So what is that? Let's say you had $100,000 in a savings account because you wanted it for your emergency fund. You listened to Dave Ramsey and that was what it was and you wanted it there. Let's say you needed more life insurance or you wanted more life insurance. So you said, I'm gonna do $100,000 up front plus I'm gonna do $10K per year. So year one, we got $110,000 going in. Out of that $110,000, you could see you got $101,000 liquid, basically, right? Your net cash value is $110,000. Well, because we did it this way, we have a term rider. So you can pick up in here, we picked up a 15-year term insurance. We had to add a term rider to be able to jam that money in to have this policy operate efficiently. Year two, you can see, check this out. You put in $10,000, the policy grows by more than you're contributing right there. And you put in $10,000, the death benefit grows by $16,000. So the principle exists all the way. By the time we hit year 15, you've put in $250,000. You have $325,000 in net cash value, right? So we put in $250,000. We started with $781,000. We ended with $2.083 million. So you've basically got an extra $200,000 of life insurance during this time. Now, the only caveat to this, because of the way we designed this, and I could go out further, I could have gone out to that point in time, but right here at year 15, in the 16th year, at the end of year 15, the term rider drops off. So right here, you can see the death benefit drops. That's because the term rider drops off. But you can see here, even at this point in time, we're gonna contribute, because of the way we have it designed, the policy premium drops down to $8,572. And check this out. You're contributing, the death benefit went down to $709,000 because that is simply, this is the permanent insurance. The term rider dropped off of this once again, but you're contributing that $8,500 and change and the policy grows, right? It's growing, but then look at the death benefit. It's growing by way more than you're contributing. So when Dave Ramsey says the life insurance company keeps your cash, right? They keep the cash and all you get is a death benefit. That is definitely a negative element of a policy if you have a traditional base, 100% base policy. And these are the policies Dave Ramsey and Susie Orman and Art Williams and the Primerica people that don't understand whole life insurance love to hate. When you just get rid of the emotion from this and you look at the math and you look at the financial structure and you come to the place that you say, listen, I know that I need to save money. I know that I need to have an emergency fund. I'd like an opportunity fund. I know I want life insurance, and I know that I'd love to do that and make sure my family is taken care of on as much of a guaranteed basis for the rest of my life as I possibly can. I've had a couple situations in the last week and a half where people have reached out to me who have term insurance and now want to get more insurance, but they're not insurable. And by doing and following the Dave Ramsey kind of strategy, Susie Orman strategy, it is really, really a dangerous situation because people are not able to get what they want when they need it most. And so when you combine, and we always talk about this, we say the most important thing that you can do with your money is get your money to perform more than one function for you in your life. So if you can have it $1, operate as life insurance, operate as an emergency fund, operate as an opportunity fund, and it's a forced savings plan, and you look at the liquidity that I just talked about. If you can't make that work, you probably got some problems going on in your personal finances anyway. Maybe you just need to get a convertible term policy and you need to eliminate debt first. If that's you, you can feel free to reach out below. We have a debt elimination program that you can have a conversation with. There's a link down in the description below. Just look at debt program. It's down there. And if you're interested in learning more about what a properly designed whole life insurance policy could do in your life, go ahead and feel free to set up a complimentary clarity call with one of the people on my team, because It is not a sales call. It is designed to help you get clarity about what's going on, what one of these would look like in your life, answer any questions that you have, any concerns, really just for you to get clarity about what would this look like in your life. It's really that simple. So I hope this made sense. I hope you know that if you are in the camp where you're confused about what happens to your cash value when you die, right? Does the life insurance company keep your money? Do your heirs get it? How does that work? Well, the answer is it depends on how the policy is designed. Hopefully this example and the illustrations and the explanation of how it works and what Dave Ramsey loves to hate on, hopefully that makes sense for you. Once again, if you have any comments, comment in the comment section below. Happy to engage with anybody who has any questions at all. Till next time, have a blessed, inspirational day. And remember, if you haven't already, make sure you subscribe, hit the bell, share this video, like this video, do all the things, because this is one of the probably most common questions that I get, and I think people need to know it. So have a great one. Talk soon.